Hello and welcome in, everyone, to another episode of The Bald Spot, the riveting podcast where we talk about everything to do with accounting. On today's agenda, Chapter 5, the most exciting one in my opinion. My name is Sunny, and I'm joined by some very special co-hosts, and I'll let them all introduce themselves.
Hello, everyone. Oh, let me get my microphone. Hello, everyone, and welcome to our podcast.
Hey guys, what's up? Welcome back. Thanks again for joining me here today. My name's Nate. I have been an amateur accountant in training for all of about three months now. So I really do know what I'm talking about when it comes to these kind of podcasts and these episodes. So I hope you guys come away with a lot of knowledge after this one.
Hey guys, Luke here.
Hi, my name is Rosette.
All right, Kara, you're up first. Can you tell us a little bit about merchandise?
Merchandising and merchandising operations. What is that, you may ask? Well, it starts with a product being bought by a retailer with the purpose of being sold for profit. These items or goods are looked at as an expense, which would then go on the balance sheet at the end of the year, listed as cost of goods sold, or better known as COGS. Profit. What is profit? It is a result when revenue from selling merchandise exceeds the cost of merchandise sold and operating expenses within a period. We could also call it as net sales, which refers to sales discounts and sales returns and allowances, which will be talked about later on in our podcast. Next, we move over to Sunny. Sunny will be talking about inventory and inventory systems. Well, Sunny, what exactly is inventory and inventory systems?
Awesome, Kara, for sure. So the merchandise inventory is the product itself that your company or your business is buying from other people to sell to your consumers. So you think like a store in a mall, you walk in, you see jeans and t-shirts and everything on the shelves. That's inventory, but as well, the stuff in the stock room behind the counter and even the stuff that's on the way to the store right now. That's all your merchandise inventory. So when it comes to writing the entry for your inventory that you just bought, you would debit merchandise inventory because it's classified as current asset, and you would credit either cash or accounts payable depending on how you purchase that inventory. So there's two different types of systems for accounting for this inventory. There's perpetual, there's periodic. So your perpetual is a system that gives a detailed record that's up to date of all quantity and cost of all of the inventory that you have on hand right now at any point in time. And then your periodic system is going to be, at the end of the period, you're going to count everything up, see how it is, see the quality of it. So when a sale occurs in a perpetual system, there's two key journal entries that are booked in. The first entry is a debit to cash or accounts receivable, however the inventory was paid for, and then a credit to sales. And then the second entry is a debit to your cost of goods sold and a credit to your inventory. So the cost of goods sold is any cost that's occurred in the acquiring of your inventory. So this can include the cost of the inventory itself, shipping and duties, fees, tariffs, anything like that. Okay, so I'd like to pass it over to Rosette now to tell us a little bit more about those shipping details that I just mentioned.
And today I'll be talking to you about freight costs, but I'm going to make it real simple for you, okay? So, freight costs is basically the shipping cost for moving inventory. But in accounting, the real question is who owns the goods when they're traveling, and also who's paying for shipping. So, the first term is FOB shipping point. This basically means that once the goods leave the location, the buyer owns them and is paying for them. So, basically, if anything happens to them when they're in transition, that's on the buyer. Yeah, that's embarrassing, I know. So, this is also called freight in, and it would be put in as inventory. Then we got the next term, FOB destination. Here, the seller is responsible for literally the goods all the way till where they're supposed to be at. Okay, so it will be to the buyer's location, and the seller is the one paying for it, and this is called freight out. So it would be recorded as delivery or seller's expense. So in short, shipping point is paid by the buyer and it's owned by the buyer, and destination is basically the seller pays for it and it's owned by the seller. Well, until it's at the location. Forgot I'm using this. So now that you guys understand freight in and out, Nate, how does discounts and returns affect the final amount a company actually earns from these sales?
I'm talking about discounts and sales return and allowances is what I'm here to chat to you guys about. When it comes to discounts, discounts are always a part of sales and always a part of any sort of transaction operation. There's usually going to be discounts involved. There are two main types of discounts that we deal with on the daily. There is sales discounts from our perspective and purchase discounts from our perspective. The easier one that we account for is purchase discounts. They're the better kind. We like purchase discounts a little more. They end up making our books look a little better. Usually the type that we get are credit discounts. So just like a normal credit transaction, we make a promise to pay whoever company X amount of money for the product that they provide us. Pretty simple. The only difference is when there's a discount, usually the discount is laid out in a term period. So we promise to pay a company $1,000 for some product that they're providing for us, and we say we'll pay that within 30 days. But if they can come back to us and say, look, if you pay within 10 days, we'll give you 2% off your order. And the way that would be formatted would be 2/10, 2% off within 10 days, and 30 or net 30. Total thing has to be paid off within 30 days. Pretty simple. Yeah, when we account for this kind of thing, when we actually go to journalize it and put it down on the books, the discount comes straight out of our merchandise inventory because we have to, when we pay them, say we're paying $1,000, but we get a 2% discount. What is that? $20. We would pay them $980. That doesn't match our AP, our accounts payable. When we first agreed to pay them the money, it says $1,000, and we're only paying them $980. In order to make up for that gap, we take $20 out of inventory because we're actually paying $20 less for that inventory. So comes straight out of there, everything's even, everybody's happy, the books balance. We have less value of inventory on hand, but the same amount of physical product. So when we go to sell it, that brings our COGS down, which then increases our sales revenue. Um, sorry, increases the margins because the sales revenue doesn't go down, the COGS does. There you go, 3 months, all that experience, it's paying off. Um, yeah, sometimes when items we receive aren't quite up to the standard we expect, they can be damaged, wrong size, wrong product, all sorts of things. Stuff happens. When this happens, we have a couple of options. We can either just send the product right back, standard return, we can get our money back, game over, or we can bargain for an allowance. So pretty much shake down the company that sent us the product. If it's damaged but still a little close to saleable, or if it's the wrong product but we can still make it work, um, we can get some money back and pretty much get a discount on the back end. From an accounting standpoint, both of these are pretty simple. Um, when we're the ones receiving the discount or the allowance, we just debit the account payable to decrease what we owe them and credit our inventory to decrease the value of what we have on hand because we've paid less for it, pretty much. Um, And just as we get discounts and we can return products and we like when that happens, customers tend to do the same thing to us. Process from the book's perspective just gets a touch more complicated. We can offer those same credit style 210 net 30 kind of discounts to our customers. Um, those ones are pretty simple to account for. They get journalized exactly the opposite as when we purchase. So instead of debiting cash and sales discounts and crediting AR from the sales side, we debit our accounts payable, credit cash, credit inventory. Super simple. Nothing too crazy going on there. But when products are returned to us, we need to use an additional account. That one's called sales returns and allowances, or SRNA. SRNA needs to be debited when a return is made to balance and account for the loss of sales revenue. Now, technically, because we never debit a revenue account, because we can't decrease it unless we've made an error, and a return isn't an error, it's just something that happens. We need an account to um, almost be like a partner account for the sales revenue, and that account is SRNA. So um, if the goods are still saleable when they come back, we can return them to our inventory by debiting inventory and crediting COGS. But yeah, it just gets a touch more complicated, but really it's not that crazy. I think you guys should be able to pick it up pretty quick. Yeah, that's the basics of sales and purchase discounts and SRNA. And I think Luke's about to sum it all up here.
Yeah, Nate, that actually makes complete sense, to be honest. Oh, yeah, this isn't the holiday special. Damn it. It happens every time. And if you guys aren't already asleep or at work, don't leave just yet, because I'm about to wrap up the last part in Chapter 5 on merchandising. The difference between the single-step income statement, the multi-step income statement, who uses them, and the difference between service and merchandising companies. Merchandising businesses aren't like service companies. Service places sell experiences like getting frosted tips at a hair salon. Merchandisers sell products, which means that they deal with cost of goods sold and inventory. And because of that, the basic single-step income statement just isn't enough anymore. The single-step income statement is basically the trust me bro financial advice. No extra information, no context, just vibing. So these companies use a multi-step income statement, the merchandising companies, because they need more information. First, we figure out the net sales, and no, this isn't the amount of nets that we've sold, since returns and discounts are part of the retail life. Then we subtract COGS to get the gross profit, the number that tells us if selling the product even makes money or if it's time to nick your nan's expensive silverware, Nate. After that, we subtract the operating expenses to get the operating income, which shows us how the business is actually performing or making money or not. Meanwhile, service companies are chilling. No inventory, no gross profit. The single-step income statement works perfectly fine for them. Merchandising companies have got to go complicated, just like Sunny and these ridiculous microphones we got when we started the show. I don't blame her. And to finish each accounting period, merchandise companies do the full cleanup, adjusting entries that fix anything that's changed, especially the inventory that's grown legs and run off, closing in entries that reset temporary accounts like sales and cost of goods sold, and the post-closing trial balance makes sure that the books are ready for the next round. The bottom line, in merchandising, a sale isn't just the end. It's where the profit story begins, and we can understand the money in even more detail. Thanks for listening, and remember, inventory never sleeps, and now they do accountants. Thank you very much.